U.S. stocks rose slightly amid a surprise jump in weekly initial jobless claims, where they did increase by over 51,000. So it does call into question the strength of the economy to a degree, but I think for the most part we recognize this is a little bit of an odd time considering a lot of the unemployment benefits that are still available out there. So I'm not sure how much we can draw from that, but today markets seem to handle it in stride, except for the Russell 2000, which did shed some of its gains from yesterday. So we'll take a look at all of that, see what it means for our posture. Then we'll get into our trade application example, where I wanted to focus on a bearish trade on one of the sectors that's starting to look a little precarious. So with that, let's go ahead and get started. Welcome to the Market Outlook video presented by Market Scholars. I'm your host, Brandon Van Zee. It's July 22nd, 2021. First of all, if you're new, welcome aboard. Remember to go over to YouTube, click subscribe on our channel, and then go down into our description area where you can sign up for our email distribution list. That's also where you'll be able to find the link to our tweet for that particular day, as well as in that description area underneath the YouTube video for those of you that watch it there. Speaking of Twitter, not only did they report earnings this afternoon and apparently did quite well because I see their stock jumping after hours, but we are also on Twitter, both David and myself and the Market Scholars corporate handle, all on Twitter. So if you want to follow me, if you're not doing so already, that'd be great. My handle is @BrandonVanZee. We really appreciate those of you that click like and retweet on these Market Outlook related tweets as well. And then last but not least, we have a presence over on Facebook. If you're not doing so already, feel free to join our group at that web address you see in the logo in front of you. All right, let's go ahead and jump into today's trade activity. And as you can see, I've got chart 4B pulled up here in front of us. Remember that this is just a 4-grid that will look at the last 3 months worth of price activity on the 4 major U.S. equity indices. In the upper left, we have the S&P 500. It was up 0.2% today. You can see that was good enough to actually switch the posture from weakly bearish to now strongly bullish. That occurred here as a result of some of these nice rebound days that we've been having here recently. So remember that when you hear us discuss the posture, what we're referencing is this technical indicator down below on the chart called the market forecast. That's a somewhat unique technical indicator that you can only find on the Thinkorswim platform or other TD Ameritrade resources. But it's a way for us to kind of judge posture from various time periods. And so the one that we use by default is the intermediate time period. So it's not overly sensitive, but gives us a general sense as to what the posture is and whether we have some strength in stocks or not. So after the last few days of rally, this is our 3rd straight up day, we are now back to that strongly bullish posture because that green line has now started tilting back up slightly. I know it's hard for you to see that with the naked eye right here. That's part of the reason why we code our labels with that information right here as well. So that way you can just read it. It says intermediate line is at 70.91 and rising. So remember, if it's between 20 and 80, kind of in that white zone in the middle, if it's rising between those areas, then we do consider that posture bullish. And if it gets above 80 into that upper reversal zone, then regardless of whether it's rising or falling, we would consider the posture bullish. So we're back to a bullish posture here on the S&P 500, but we're not yet to new all-time highs. We're kind of in that territory, just not quite there yet. Moving right along now to the Dow Jones Industrial Average to the right here, you can see the Dow was up a little bit today as well, but not much. It was only up 0.07%, so just a little bit better than break even. Somewhat similar to the S&P 500. This is the 3rd straight up session for the Dow, and did reverse some of our more difficult trading that we experienced here, particularly on Monday. That was a pretty ugly looking candle right there. So it's really nice to see the markets rebound so quickly after it seemed like there's a bit more concern in the air regarding the Delta variant and other things just earlier this week. So after 3 straight up days, it wasn't quite enough in this case to push us back to a bullish posture the way that we were able to there with the S&P 500. You can see in the case of the Dow, we might be a little bit further down below the highs. And also keep in mind the Dow is already different than the S&P 500 in that its true high actually occurred back here on May 10th. when we hit just over 35,000 there. The S&P 500, of course, just hit an all-time high here as recently as July 14th. So from that perspective, maybe not quite as much strength here out of the Dow. So we're close probably to getting that posture change, but we're just not quite there yet. You can see that that green line is still tilted a little bit lower with the intermediate reading at 70.66 and falling. You do have green moving averages on both of those charts, and a reminder that those green colored moving averages, first of all, they're 30-day moving averages for those of you that might be newer to these videos. And what that signifies when you see a green tip on your moving average is that price is above the rising 30-day moving average. So you can see here earlier in the week we had a red moving average for one day, then we went to yellow the next day, and the reason for that is on this particular day, price was below a falling moving average for one single day. The very next day, it rose back above that falling moving average, which colored it yellow. And then the last couple of days, we've seen price stay above the moving average, but the moving average has now started to tilt higher again. So that's generally perceived bullishly and is accommodative towards more bullish activity within the market itself. Down below here, you can see in the lower left-hand corner that the Nasdaq Composite actually led the way for the markets here today. It was up 0.36% today, and this was also the third straight up day for the Nasdaq Composite. And similar to the S&P 500, we went back to a strongly bullish posture here as this green intermediate line stopped going down and is now rallying back higher once again. Somewhat similar to the S&P 500, you can see that we'd have to go back here to the middle of July, just a couple weeks ago, to get back to all-time highs. So not all that far away. Under the right set of circumstances, you could envision that happening here within the next week or so if markets remain bullish. Now, we'll just have to see if that's what the markets have in store for us. But right now, it looks like further all-time highs are more likely than not, considering the momentum behind these securities that are here. And then last but not least is the Russell 2000 in the lower right-hand corner. In this case, it was the only index that was down today in terms of the four key ones that we look at here. And it was down pretty substantially. It was down 1.55%. So it did give back a big chunk of yesterday's gains. The good news is we're still above where we saw the markets rise to after Tuesday's session. Now you'll notice that the Russell 2000 is kind of hard to see here because usually we have two green dots on the board whenever we have a cluster. In this case, because the low tag is on there, it's kind of covering it up, but behind this tag there is a green dot, and you can see it down below here as well if you squint good enough. And maybe I can right click and go to maximize this cell so you can see it a little bit better. Now when I do that, you can actually see that green dot emerge on the price candle along with this green dot down below here. This is ThinkScript programming code that we've got built into our charts. So of course all of you that are premium members have access to this. But I wanted to point that out because that was actually our first oversold cluster signal on any one of these four major indices in over 3 months. If you were to look back on all of this activity for the S&P 500, we have no oversold cluster signals. Same thing for the Dow Jones Industrial Average, and same thing for the Nasdaq Composite. So at a minimum, it's been at least 3 months since we've had an oversold cluster signal on one of the four key market indices, and that is now the Russell 2000. So I don't think we should have been all that surprised to see the Russell 2000 have a nice rally the last couple of days. It doesn't really change the fact that the Russell 2000 continues to be our laggard. So yes, did things get pushed to the extreme on the downside? Absolutely. That's why we got the oversold cluster signal to identify that for us. But after the last couple of days of rally and then watching it fizzle today, I'd still be a little bit cautious around this one. And I could be wrong about that, of course, but I just don't like the way that it is acting at this level where we clearly have a red moving average here, which signifies price below a falling moving average in this case. And it was the only one out of the four that could not put in that third straight up session today. In fact, not only was it a down session for the Russell 2000, but it's a pretty ugly down session. 1.55% is nothing to sneeze at. So not entirely thrilled with the way the Russell 2000 chart is setting up here. You do have the benefit of now having a weekly bullish posture, however, so I should point that out, where you have that light green background color. So notice the shading of that green is different than the dark green you see here for the Nasdaq and the dark green you see here for the S&P 500. So what this is signifying is that in this particular case, the green line did emerge out of that lower reversal zone. So the lower reversal zone on the market forecast indicator is 20. So once it emerges up and through that and continues to rise, right now we're at 27 and rising, that does switch to that what we call weekly bullish posture. If that line continues to rise and gets above the chart's 50th percentile, then it'll start plotting that darker green shaded background to tell us that we would then have a strongly bullish posture. But I just don't know if it's going to have the oomph to get there. Obviously, a lot of it just depends upon how earnings come in and what happens with COVID and any sort of geopolitical events. So there's a lot of it that's out of the market's control. But just from an organic chart reading perspective, it just doesn't look all that solid right here, with it struggling to even get to the moving average, right? A lot of times you see that behavior where you have this big down move, you get the oversold cluster, you push back up as a reversion to the mean type of a move, you kind of go back up to where that falling moving average is, and then you start rolling over again. Well, in this particular case, we couldn't even get remotely close to the moving average. So it just shows that the bears have a bit more control here within the Russell 2000 chart than what we're seeing with some of those other large cap and mega cap types of indices out there. So if you're looking for bullish price action, it seems like it is kind of the big behemoths out there that are allowing for that. I know we did a bullish trade on NVIDIA in one of my classes earlier this week, and I've noticed Microsoft doing quite well as it scrolls across the screen on CNBC. So those are kind of exemplary of this idea that the mega caps are kind of leading the way right now, and the small caps are kind of being left in the dust. And you can kind of see that playing out here right before your eyes with these four charts as well. All right, let's go ahead and take a look now at our three green arrows chart setup. This will be chart 4D for those of you that are following along at home. Well, the good news is we don't have any securities that have three red arrows at this point. And that is something new, because the Russell 2000 has had three red arrows going all the way back to July 6th. So that's a few weeks at this point. But today, it finally emerged out of that condition when we got a green arrow on the stochastic down below. So whether that holds or not is anybody's guess. Right now I have my doubts, because we didn't quite have a bearish engulfing candle today, but it was awfully close. It just gives you the sense that there's some pressure building up within the small caps that is more likely to push it down. And if that happens, I think we get a red arrow back quite quickly on the Russell 2000. Now, one possibility as well is that the MACD could very well go to a green arrow at that point, at the same time that the stochastic goes to a red arrow. So we'll have to keep our eyes on it, but I think it's still a precarious position that small caps are in right here, and it would not surprise me at all if within just a week or two we were back to three red arrows status. The other charts are still looking pretty good on that count. However, we don't have a three green arrows chart in sights here at this exact moment in time. All of them are struggling on the MACD's perspective, right? We've got a red arrow there on the S&P 500's MACD. We've got a red arrow there on the Dow Jones Industrial Average MACD and the Nasdaq Composites MACD. Now, the good news is we're trending back towards the zero line, so we're starting to get a little bit more positive price behavior there, and some positive momentum rolling into the charts. But it's got a little bit of work to do It would kind of surprise me if it happened as soon as tomorrow, to close out the week. My guess is it's probably not going to get there unless we have just an explosive day tomorrow for some reason out of the gate. But my guess would be that we're going to have to probably wait until early next week at the earliest before we get green arrows there on the MACDs on those other 3 charts. So again, same story. This is a market that is probably favoring the larger securities that are out there, and the small caps are the ones that are kind of on the outside looking in. Let's take a look here now at our 1040 crossover method. This is chart 4C for those of you that are following along at home. And as you can see here, we do have some good separation between the orange and the blue lines on all 4 of our charts. But the one that is the most concerning is the one that I've been mentioning concerns with already in this video, which is the Russell 2000. You'll notice here that the Russell 2000's price action is now below that orange line. So let me right click on this and maximize the cell so we can see this a little bit better. And you can see that our price action is below the orange line. Remember, on this chart, the orange line is a 10-week exponential moving average. This is a 3-year weekly candle chart that we're looking at here. So we're now below the 10-week moving average. In fact, at its lows, we nearly touched the 40-week moving average. Now, we've bounced nicely up and off of that since Monday's lows. So that's the good news. We do have some positive takeaway from that bounce, I guess you could say, from the true lows of the week, but it's still not looking all that great. You'll notice that we have a red arrow on this chart signifying that price is now below that orange line, and while that's not the important part of the chart, remember what we're looking for with this particular chart are the crossovers. So that's why when you see like the orange line cross the blue line, you see the color background change, and then likewise over here when the orange line went up and above the blue line, you see the background color of the chart change back from pink back to green once again. So what we're looking for and what we want to point out if it were to occur is when the orange line crosses down below the blue line or the 40-week moving average. That would be known as a death cross if that were to occur. And the reason we have these little arrows on the chart is just kind of a little bit of a foreshadowing of what could occur. Now, we could also go right back up like we did this time and this time with those 2 green arrows right there. So it's more of just a warning sign. It's not the true change of a signal or a condition change here, but it's just giving us a heads up that there's some wear and tear on the chart that we're going to want to be on the lookout for. You can also see down below here on this PPO that this green line is clearly going lower. And remember, when that green line gets to this 0 line, this 0 horizontal kind of yellow gold line down below here, that would also be when we have a crossover here. So when you're in a nice, strong bullish market, you want to see this green line down below trending higher because it's telling you the more sensitive line, the 10-week moving average, is going up at a more rapid pace than the slower or less sensitive moving average, in this case the 40-week moving average. But there can also be extremes, and that's kind of what these little dots above the PPO were telling us on the Russell 2000 here during kind of that February-March time period was, yes, we were in a very strong market at that time, but it nearly got too strong because that was kind of in the top 10 percentile of the rankings of the PPO over the last 3 weeks. And stocks don't just go up forever without ever looking back. So this is part of that give back that we've seen here the last 3 weeks in the Russell 2000. And we've really kind of stalled out ever since kind of getting those green dots right there. So we want to be on the lookout for a possible moving average cross. But remember, this is not something that occurs regularly. It's something that, if you see it once or twice a year, it would be fairly normal. You don't see it multiple times per year typically. Now, this was a little bit of an abnormal year back here in 2019 for the Russell 2000 because you did have that slop and chop sideways. But usually you have more consistent trends both up and down where you don't see those golden crosses go into death crosses and then back and forth and back and forth. So anyway, if that happens, we will keep you abreast of that here in the Market Outlook video. All right, let's go ahead and take a quick peek on over here to the internet. I always like to get a chance to say thank you to those of you that help support these market outlook videos. Now, I did fall short of my goal the last time I did the video, which was a week ago. We didn't quite get to 100 likes on the video. We were at 97 as of this exact moment in time. So I appreciate those of you that clicked like even as recently as today, because I noticed that on Tuesday when I went about my business to try to see if I was going to do the video that night or not, there were only 90 likes there. So I ended up having some family things going on Tuesday afternoon that I needed to attend to. By the time I got all that wrapped up, it was pretty late in the evening. And so, like I always say to you guys, if you can get me 100 likes on Twitter for these market outlook videos, I will prioritize the video. If we can't get to 100 likes, then I'm not going to prioritize my video, and I'm not going to stay up until 2 o'clock in the morning doing it or something like that for a free video like this, right? So do your best to help support the video, and many of you do that regularly. In fact, I did get a question earlier today about some of the ways that you can click like depending upon how you are viewing our video. And so since we're here on Twitter right now, one of the more obvious ways to do it is just go over to our Twitter feed, and up here you can see the web address. It's just twitter.com/Brandon Van Z in my case, and then David's I believe is like David Settle 42 I think. But anyway, if you go to the tops of our Twitter feed, you'll see that we have the opportunity to pin one tweet. So David and I usually pin the most recent market outlook video that we did to make it nice and easy for you guys. So that way you don't have to go scrolling through all the tweets that we have along the way. You can just simply go up to the top of our Twitter timeline and click the heart button right below the video there. And if you can hit the retweet button, even better. Both of those would be fantastic. So that's one way, one out of 4 ways where you can get the Twitter information if you want to help support this video. Another way would be if you are on our website. So now I've clicked on over to our website. This is David's video from yesterday. So many of you watched this video right here on our website by coming up here to kind of the market outlook area and just clicking on the tab itself, or perhaps clicking on the archives. Either way, it can get you to this area. And then you just watch the video that's embedded within our site here. Well, you'll notice we have these 2 little widgets below that video. One of them is the Twitter widget, and one of them is the Facebook widget. So on this Twitter widget right here, you just simply come down and click that heart button right there. So you can do it nice and easily while you're watching the video on our website. So that's the second out of 4 ways that you could click like on Twitter there for us. A third way would be for those of you that watch our videos directly on YouTube. So here's David's YouTube video at youtube.com from yesterday, and you'll notice that yes, we do have these thumbs up and thumbs down. I don't really look at those all that much myself, but those are also helpful for you to click if you so desire. But if you're looking specifically for the Twitter area to click like, you can come down into this area that's our description area, and you'll kind of see a couple of links right here, so it might not be obvious all at front, but if you go to this area that says show more within the description area directly below the YouTube video, so I just clicked on it, you'll notice that there's a line item here that says like and retweet today's video on Twitter, and yesterday David had his link right there. So after we post these videos on YouTube, we then go back into the description area and update these links with whatever that day's Twitter information is as well. So for those of you that don't really want to leave YouTube or what have you, you can just find our tweet for that day by looking in the description area. And then once you click on that, it'll take you to the area where you can click the heart button underneath the Twitter feed there as well. And then last but not least, so that's the third way that you would be able to click like for us there on Twitter. And then the fourth way would be on our emails. So many of you are part of our email distribution list where you get the updates to these videos. And if you scroll all the way down to the bottom of the email, so this is the one that David sent out yesterday, you'll notice that kind of down in this general area where you see the S&P 500 clusters and different things like that, there's some links in here to different social media outlets, and one of them is Twitter. And again, we update that within that area with that day's tweet for the market outlook. So if you click on that, it would then take you to that tweet where you could then like it there. So there's 4 different ways that we do update it on our end, because we know many of you will kind of associate with our video in different ways. But all we ask out of you is 5 seconds out of your time to help support this video, because as we've mentioned many times, we don't make money off the video. So it's completely a volunteer basis. And I don't want to see a slippery slope happen where at some point we just don't do the videos in the future or don't do them as often. So we try to be very upfront with you on this point that we do expect a certain amount of engagement and promotion out of these videos in order to motivate us to do the videos. Remember, we are teaching all day long. I taught a 3-hour class today, so I don't need to go and spend another 2 or 3 hours doing these YouTube videos at night just to scratch that itch for me to teach. I'm teaching already all day. So we do them to help educate you guys, help you stay in tune with what's going on with the market, but in return, we expect you guys to help promote these videos as well. And we don't need you to be like the world's biggest cheerleader and, rah, 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 this thing and that thing. If you want to be a big supporter that way, great. But I think the bare minimum that we can ask out of you is just simply click a button like. I don't think that is too disruptive to your daily activity. So if you can train yourself to click like every single day on these Market Outlook videos, that will help ensure that we can continue to do them in the future on a regular basis. If we don't get that, that promotion out of you guys and that engagement out of you guys, then we would have to rethink whether it's worth our time to spend the 2 or 3 hours that go into making this free video every day. So especially for those of you that are not our premium market scholars, if you're getting this information, this content for free, the least you could do for us is click like for us there on Twitter. So anyway, I thought I would share that with you since I got that question earlier today as well. Speaking of questions that I got today, I taught my question and answer session earlier. I mentioned it was a 3-hour extravaganza as they've become here more recently. We got a question about how to adjust some of the settings so that way we can look at a chart like Ben, which was Franklin Resources, on the dividend stair-step chart without having a skewed chart as a result of their $3 special dividend that they paid back in 2012. I also got a question about my predictions on oil and where the world would be in the next 50 years in regards to whether we would be using crude oil and what that means for oil stocks and electric vehicle companies and things like that. Also got a question about how to review Tootsie Roll's business model as a dividend growth investing candidate. Also got a question on a discussion on foundational stocks for a dividend growth investing portfolio. Sometimes you'll hear me refer to those as Mount Rushmore stocks. So if you're a premium member, feel free to check out that portion of the video at 1 hour and 15 minutes if you want to hear my 4 Mount Rushmore stocks that would be a great foundational pick to start a dividend portfolio with. Also got a question on selling puts every time the stock market goes down 1% and how you can kind of use stocks like those that are giving you oversold cluster signals like the Russell 2000 did there on Monday to help kind of slim down your potential list there. I also got a question to elaborate more on the CRISPR stocks, which last week I already spent an hour on the CRISPR stocks for a separate question. In this case, I ended up spending another 50 minutes kind of solidifying my thoughts as to how I'm handling the CRISPR stocks in my own account and how I'm thinking about that going forward, and some tips and tricks as to how we want to go about that process in terms of baskets of stocks and how we think about long-term investing with speculative investments that actually don't have profits yet. And then also had a question about doing buy rights in our dividend classes. So feel free to check out that content there on our website if you're interested and you are a premium member. And remember, tomorrow, David will be teaching his technical analysis class, so make sure you're checking that out as well. All right, let's go ahead and get back on track here with some 12 grid analysis. Starting with chart 5A, this is our asset class 12 grid. And as you can see, we've got a nice mix of green and red backgrounds here. And remember, the background colors are signifying what is the current posture of these various entities. So as we're looking at this, what I generally want to kind of identify are charts of interest in terms of potential breakouts or bounces that might be happening. One thing that has been catching my eye here recently is the strength in the bond market. You can see that the international bonds, or I guess you could call them foreign bonds here with ticker symbol BNDX, has been doing quite well. It did finish at the highs of the day today and continues to have a strongly bullish posture after breaking out here in the last week or so. Long-term U.S. Treasuries, maybe not quite as strong as what we saw there out of the foreign bonds, but nonetheless, I think they continue to point higher here. As you can see, we continue to have that strongly bullish background color, and we haven't even touched that 30-day moving average since going all the way back here to the first couple of days of June. So bonds remain very strong, which of course means the opposite in terms of interest rates. And you can see here that the 10-year U.S. Treasury yield has once again fallen today. It slipped down to 1.26%. Remember, you move that decimal point over 1 in order to read that on the Thinkorswim platform. So 10-year Treasury at 1.26%, and you can see what that trajectory has been for yields over the last 3 months. It has not been good. That'll actually play a role in our trade application example a little bit later in the video. Other areas of interest, you can see gold has started to break down a little bit. That doesn't break my heart. Remember that I did the bearish gold trade here about a week or so ago, where when we sold a bear call spread on gold. So it hasn't lit the world on fire by any means, but it's doing approximately what I wanted it to do. It kind of startled me a little bit out of the gate because I think we did that in these candles right here, and then it did pop up a couple of days later, but now it's kind of right-sized itself, and it's right back to where we initiated that trade. And remember, when you're doing a bear call spread like I did in that particular example, even having a sideways chart will help win us money. Now, we do want to make sure that we see that trade through till expiration in order to try to benefit the most out of that trade. So right now it has gone sideways. Doesn't guarantee that it will between now and the end of that trade, but so far so good on that trade. And you can see it is doing what I had anticipated that it would do, which is struggle at that downward trending 30-day moving average. Gold did finish up just a hair today, but it does seem like it's struggling with that line. So as long as that continues to be that case, I think that bear call spread should be in reasonably good shape. So I'm glad that I chose the bear call spread in that case as opposed to a long put spread or something along those lines that would be a little bit more directional. This has given me a little bit of flexibility in this trade, and it allows me to kind of breathe a little bit easier despite having that move initially against me. So kind of reset the deck here. We're right back to where we started, but on a profits basis, we've actually earned a few bucks in profits because the further that the trade goes sideways and the longer that takes, the more time decay you're earning on your trade there as well. We did have oil up today once again. This is its third straight up session there for USO. It was up 1.86% today. We're right back to that moving average. Now that was such a deep cut right there out of oil. I still feel a little bit nauseous for how volatile this security is. And therefore, I don't know if I would want to make a big bet at this level. I think if I were forced to, I think I would probably prefer to be a little bit more bearish than bullish, knowing that you probably scared a lot of participants in that market right there. But we all know that oil kind of, marches to its own drum, so to speak. And it can be affected by geopolitical concerns and a lot of other things that you don't see with other asset classes out there. So I wouldn't hold it past it as far as having a volatile move to the upside. But right now, I think if I were forced, I would prefer to be on the bearish side of the equation, similar to the way that I kind of handled gold. In other words, I don't know if I would be aggressive with oil here, but I might be willing to do a bear call spread, depending upon how things shook out there. You can see that the US dollar was up today. So as I was joking on Twitter on Tuesday night, it's a great year for bucks. The Buccaneers win the Super Bowl, the Milwaukee Bucks win the NBA championship, and the buck here that we are concerned with, the US dollar, has had a good year as well and continues to be above that rising moving average and continues to have that strongly bullish background color right there. So anyway, be aware that Bitcoin did have a little bit of a bounce higher here. I think you had some positive vibes coming out of that conference yesterday where you had Elon Musk and Cathie Wood and Jack Dorsey, some of the heavy hitters within the Bitcoin community, all come out and kind of support it for a little bit. And this is a chart that needs it. This is a pretty ugly looking chart here, but you do have a little bit of a rally here in the last couple of days, so maybe they can build upon that. But right now we remain below a falling moving average there on Bitcoin. In terms of the sectors now, let's go ahead and pull up our chart 5C here. And this is the U.S. sectors 12 grid. So these are market cap weighted, but you can see we've got a little bit of a mixed bag here from a sectors perspective as well. The charts that I think look the best in terms of bullishness are going to be technology, which, as I mentioned earlier in the session, NVIDIA and Microsoft and a few others still doing quite well. Even some of the lesser known tech stocks like DocuSign doing pretty well for one of our top-down trend trading classes that I teach on Mondays. So technology is kind of coming into its own right here. It is up at a little bit of a resistance area, but it's had so much strength here recently. I would not be surprised at all if we can get up and through that resistance area. It's been a nice healthy bounce there where we've closed near the highs of the session the last couple of days there. So I like what I see out of technology, but I also wanted to point out healthcare. Healthcare looks pretty darn good all of a sudden, right? We've talked about Moderna and BioNTech as being a couple of biotech superstar stocks here recently. And of course, I've been talking a lot about CRISPR stocks here lately as well. So there are certain areas within healthcare that I think worth investigating. You actually have a pretty solid looking trend there all of a sudden. We do have a little bit of slippage in some of the other areas, however. We've been talking about the slippage in materials and energy for a couple of weeks at this point. Real estate had been one of the really strong areas of the market, but even it's kind of pulled back the last couple of days. So we'll have to keep our eye on that. It's had a really good move. Makes you wonder if it's about time for real estate to take a little bit of a breather after such an extended run there. But the chart that concerns me quite a bit is the one up here in the upper rung, second from the left, which is financials. And this is actually ties right into our trade application example here today as well. What I ended up doing with this particular chart is I sold short this particular security. Now remember, if you're a premium member of Market Scholars, I already sent that information out while the stock market was open. So you would have had that information before the market closed as a benefit of being a premium member of ours. But what I did was I short sold XLF, the ETF itself. I looked at a few individual companies out there. I was pretty close to doing the same thing on Northern Trust. I think that chart looks pretty ugly here as well. But I figured, you know what, let's just keep it simple and just do it sector-wide in this particular case. You can see that the green line is falling, which is why the background color of the chart here is pink. And it's telling us that we have a strongly bearish posture on financials here. And you can see that ever since topping out back here in early June, we've actually put in a series of lower highs and lower lows. And more time than not, as we've approached that moving average, we bounce down and away from it. So today would be a bit of a close below the low of the high day, with yesterday being that high day. We had a really nice 1-2 punch to the upside there for the financial stocks on XLF here. But today it gave that back. Remember, the market was up today. Small caps weren't, but this isn't a small cap product here. This is XLF, which is market cap weighted only in the S&P 500. So this was definitely an underperformer today, and I don't really like the looks of it bouncing down and away from that falling moving average there. So I sold short some shares of this ETF. I put our stop loss a little bit above this candle back here on July 12th. We're doing a 1-for-1 reward risk relationship, which would mean that our reward that we're seeking for this would be down here. That would cross this candle and these two candles over here. So if we can kind of get into that lower range again, we'd be willing to take our profits off the table there, and we'd be willing to let our losses accumulate until we got above this candle right here. Now remember, you do need a margin account in order to short sell an ETF like this or a stock. So this is not a trade you would be able to implement in a retirement account, but nonetheless could be worth investigating. And remember, if you don't like short selling securities, securities. You could also look at selling a bear call spread or something along those lines as well. But just didn't really like the looks of the XLF chart here all of a sudden. And I thought this was maybe an opportunity after a big move up the last couple of days to kind of reload the gun for a bearish trade to kind of offset some of those bullish trades that we already have in the portfolio. So that's what I had for you here today. If you got value out of this presentation, I would encourage you to go over to Twitter, click like for me there. I showed you the 4 different ways that you can accomplish that earlier in the video. We do appreciate your guys' support. We know many of you really enjoy these presentations, and we'll do our best to help you along with your learning going forward. So with that, I want to wish you all the best of success with your trades and your investments. Goodbye for now.